It's been a terrible year for investors on the JSE. Year to date, the market's down 13% in rand terms, 24% in dollars. Emerging markets down about 12% in dollar terms. In terms of the MSCI, about 1% down dollar terms, versus the South African fixed income space in rands up about 7%, both for money market and bond investors. However, property has been particularly bad, down 25%. Contextualizing those kind of returns historically, this is the fourth worst performing year that we've seen on the market since 1960. The last period being this bad was 2008, when the market lost 25%. Taking a slightly longer term perspective, over 5 years, the JSE has actually underperformed inflation by 2.5% a year annualized over the last 5-year period. Putting this into perspective, what's particularly interesting is that this tends to happen over 5-year rolling periods only 20% of the time. So both 1 year and 5 years, really, really bad times for investors on the JSE. How have we dealt with this? Well, North Star has 4 strategies: income, managed, South African equities, and global. And we're happy to say, in terms of those 4 strategies, all in the form of unit trusts for our investors, 3 of our funds are in the top quartile over the past 12 months, and one fund, the managed fund, which has a 3-year track record, is in the top 30% of managers too. 2 of our funds are in the top decile over the last year, top 10% of managers. So we feel we've handled the environment relatively well. How have we done this? Well, 6 years of hard work at North Star, building models on South African and offshore companies, has really paid off for us. On top of that, our entire framework in terms of asset allocation is detailed and organized and managed, and has helped us to avoid buying expensive assets over the last 12 months. How do we feel about the markets going forward, however? We're becoming increasingly positive on South African equities, and we pose 3 reasons why that's the case. Firstly, statistically, the JSE has underperformed, as we indicated earlier, quite dramatically over the last 5 years. But statistically, you don't find that 2 negative periods tend to back each other consecutively. That's the first point. Secondly, in terms of real returns, at 2.5% negative real returns over the last 5 years, when this happens historically, it's followed by dramatic positive real returns. In fact, the average being 16.7%. So purely statistically, the odds are in favor of investors going forward. Secondly, from a valuation perspective, the JSE is much closer on a normalized basis to its long-term PE, from being very, very high over the last few years. Added to this, debt levels of companies are low, cash flows are improving, earnings are improving, and in dollar terms, the JSE is a very cheap market against other markets globally. Our third and final reason why we're more positive of the market going forward is actually our own buy list, the most credible area to look at. What we're finding is that most companies on our buy list are between 20 and 25% undervalued relative to what we believe their true intrinsic values are. Adding these 3 reasons together gives us a comfort that returns going forward on the JSE will be significantly better than what we've seen over the last 5 years, and we feel positive for the outcome of our North Star clients.